This is ShadowQuant Forex Edition, brought to you by AriesLabs.ai. Before we begin, please note, what you are about to hear is an AI agent panel. All analysis, voices, and production are generated by artificial intelligence. Nothing you hear constitutes financial advice. Always do your own research. Today is Sunday, July 12, 2026, and this is the After Hours session. Now, let's get into it. The US dollar is holding its ground while the geopolitical situation in the Middle East escalates with new strikes on Iran and the closure of the Strait of Hormuz. With the Bank of Canada and the ECB making rate decisions midweek and inflation data printing above target, the market is caught in a squeeze between rising geopolitical risk and sticky domestic prices. Welcome to ShadowQuant. We are entering the week of July 13, 2026, with the Fear and Greed Index at a palpable 14, deep in fearful territory. This is extreme fear. Historically, this level of fear often persists for days to weeks before a true reversal, meaning the default expectation is for risk assets to remain under pressure. The VIX closed at 15.3 on July 10, down 0.81 points, which seems deceptively calm given the headline risk of U.S. strikes on Iran. But let's look at the actual data on the board. Euro-dollar is sitting at 1.1415, right at the open of the week, having closed Friday at the exact same level, suggesting a quiet weekend or data freeze. Cable is at 1.34024, dollar-yen at 161.706, and gold at 4,111.96. The 5-day range for euro-dollar is 1.13912 to 1.14609. And for gold, it is a massive 4,021.74 to 4,180.66, showing wild swings even in a fearful regime. Let's look at the macro backdrop. We have a Fed funds rate of 3.62%, with the 2-year Treasury at 4.16% and the 10-year at 4.54%. The yield curve is flat at plus 0.35 pp. Inflation is sticky. CPI year-over-year is 4.17%, and core PCE is 3.41%. Both are well above the Fed's 2% target. This creates a hawkish pressure environment. The real GDP growth is 2.9%, but the GDP nowcast is lower at 1.19%. This divergence suggests the economy is slowing, but inflation is not cooperating. This is a stagflationary scare, which typically supports the dollar and gold, not risk currencies like the Aussie or pound. Adding to this, we have the BOC rate decision on Wednesday, July 15, and the ECB rate decision on Thursday, July 16. With US CPI and Fed Chair Warsh also taking center stage this week, the dollar is likely to be the beneficiary of any higher for longer rhetoric. The trade-weighted dollar index is at 120.69, down slightly week over week, but the internal strength remains. My macro view is that the risk-on classification in some models is being contradicted by the hard data of rising breakevens, 5-year at 2.28%, 10-year at 2.24%, and the geopolitical shock. We are in a fear regime for a reason.
Technically, the charts reflect this indecision and underlying weakness. Let's start with euro-dollar. It closed Friday at 1.1415, which is right in the middle of its 5-day range, 1.13912–1.14609. It's testing the midpoint. The 5-day low was 1.13912 on July 8. A break below that level would open the door to 1.135, but for now, it's consolidating. Cable is at 1.34024. 5-day low is 1.33223, July 8, and the high is 1.34519, July 10. It's currently sitting just above the recent consolidation zone. The fact that it hasn't rallied to test the 1.345 high suggests selling pressure is keeping it down. Dollar-yen is at 161.706. The 5-day low is 161.2825, July 10. It's holding above that low, which is the key support. If it breaks 161.28, we see a move toward 160.5. But here's the kicker, gold. Gold is at 4,111.96. The 5-day high is 4,180.66, July 7, and the low is 4,021.74, July 8. That is a $160 swing in 5 days. It has pulled back from the high of 4,180 to 4,111. That's a correction, but it's still well above the 5-day low of 4,021. The chart structure for gold is volatile but holds higher lows relative to the week's start. For FX, the trend is range-bound with a downward bias for euro sterling but bullish support for dollar yen at 161.28.
Let's look at the institutional flows, specifically the CFTC commitments of traders as of July 7. This is where the smart money is hiding. The data is stark. Leveraged funds are strongly bullish on euro, plus 1,696 net, week-over-week change, plus 2,164, and yen, plus 1,696 net. Week-over-week change, plus 91,779. Wait, yen. Leveraged funds are strongly bullish on yen. That implies they are shorting dollar yen, since yen is the base. A week-over-week change of plus 91,779 contracts on yen is a massive shift. They are piling into yen longs, betting on dollar weakness or yen strength. Conversely, they are strongly bearish on Swiss franc, net 7,218, week-over-week change plus 2,448, and strongly bearish on Canadian dollar, net 85,957, week-over-week change plus 2,144. They are shorting Canadian dollar heavily, and on the dollar side. Leveraged funds are strongly bullish on the DXY, net plus 4,438, week-over-week change 7,100. Wait, the net is positive, but the week-over-week change is negative, 7,100. They are adding to their long DXY positions, but unwinding some from last week. However, look at the asset managers. They are net long euro, 3,665, and net long pound, plus 16,568. So the smart money asset managers is long pound, while leveraged funds are short pound, moderately bearish, net minus 468. This divergence is key. The COT data shows a massive bet on yen strength, short dollar yen, and Canadian dollar weakness. This contradicts the risk-on narrative. If leveraged funds are betting on yen and DXY strength simultaneously, they are positioning for a dollar weakness in G10, but strength in safe havens or a specific dollar-yen unwind. My flow read, the massive yen long suggests a potential squeeze if dollar yen doesn't hold 161.28. Also, the short Canadian dollar, net 85,957, is the largest single position in the report. That's a huge bet against the loonie.
I'm here to stress test the consensus. The consensus seems to be risk-off due to fear and greed at 14, but the COT data shows leveraged funds are long euro and long yen. If everyone is shorting dollar, what's the risk? The risk is a dollar squeeze. Let's look at the VIX. It closed at 15.3 on July 10. That is LOW volatility. Low VIX plus extreme fear plus geopolitical shock. Iran strikes equals a black swan upside for the dollar if the strikes escalate. But here's the specific counterpoint. The COT data shows leveraged funds are short Canadian dollar, net 85,957. The Bank of Canada is making a rate decision on Wednesday, July 15. If the BOC cuts or signals dovishness, the Canadian dollar could crash. But if they hold or hike, the short Canadian dollar trade could get squeezed. The risk is not bearish continuation for all. It's a volatility spike in CAD/JPY or dollar CAD. Also, look at the gold chart. It's at 4,111.96, down from 4,180.66. The fear and greed is 14, yet gold is pulling back. Why? Because the dollar is strong. The risk is that the safe haven bid in gold is being overwhelmed by a stronger dollar bid. The SPECTER view, the extreme fear, is misleading. The market is not fearful of a crash. It is fearful of stagflation. And in stagflation, the dollar and gold are both bid, but they often compete. The risk is that the dollar outbids gold, causing a gold correction below 4,021.74, the 5-day low. That's the specific downside risk, gold breaking its own low because the dollar is too strong.
Let's tie this together. We have a macro regime of stagflationary fear, pulse, high CPI, flat curve, geopolitical shock. We have a technical setup that is range-bound but with gold showing massive volatility and dollar-yen holding support grid. We have institutional flows that are massively short Canadian dollar and long yen, betting on dollar weakness or commodity weakness, CIPHER. And we have a contrarian risk that the extreme fear is actually a dollar strength trap, where the dollar outperforms both gold and equities, SPECTER. The narrative for this week is dollar resilience. The BOC and ECB decisions will be the catalysts. If the ECB holds hawkish, euro could break 1.13912. If the BOC holds hawkish, Canadian dollar could rally against the shorts. But the dominant force is the US data, CPI and Fed Chair Warsh. With CPI at 4.17% and core PCE at 3.41%, the Fed has no room to cut. This supports the dollar. The COT short Canadian dollar is the most crowded trade. If Canadian dollar rallies, that short gets hurt. But the broader view, the fear and greed at 14 is a buy the dip signal only if you buy dollar or gold, not risk assets. The default expectation is bearish for euro, sterling and RC, but bullish for dollar, yen and gold as a hedge. The risk-on classification in the intelligence digest is likely lagging. The actual flow is risk-off with a dollar bias.
Let's get the weekly calls from each analyst. Remember, these are factual reads based on the data provided. The macro data is clear. Inflation is sticky at 4.17% CPI, and the Fed is at 3.62%. With the ECB and BOC decisions midweek, and no room for Fed cuts, the dollar will be supported by yield differentials. The 10-year two-year curve is flat at plus 0.35 pp, which historically precedes dollar strength in risk-off regimes. My call, dollar-yen bullish, target 162.5 by Friday, driven by the yield spread and the leveraged fund short covering if it breaks 161.28.
Technically, euro-dollar is at 1.1415, right in the middle of its 5-day range. The 5-day low is 1.13912. With the ECB decision on Thursday, July 16 and the fearful sentiment, there's no technical basis for breakout above 1.14609. The chart is compressing. A break below 1.13912 would confirm bearish continuation. My call, euro-dollar bearish, target 1.135 by Friday, targeting a break of the 5-day low.
The COT data shows leveraged funds are short Canadian dollar with a net position of 85,957. This is the largest single position in the report. The BOC rate decision is on Wednesday, July 15. If the BOC signals any dovishness, or if the Fed remains hawkish, which it is, given 4.17% CPI, the Canadian dollar will be sold off. The flow data supports a continued sell-off in Canadian dollar. My call, dollar CAD bullish, target 1.425 by Friday, targeting a break above the 5-day high of 1.42264.
I'm stress testing the gold trade. Gold is at 4,111.96, down from 4,180.66. The VIX is low at 15.3. The extreme fear is in equities, but gold is pulling back. This suggests the dollar is outperforming gold. The risk is that gold breaks the 5-day low of 4,021.74. However, the COT data shows asset managers are long gold, implied by commodity longs. So, the downside is limited, but the fearful regime means investors are buying dollar. My call, cable neutral, target 1.34 by Friday, range bound between 1.33223 and 1.34519, as the pound is caught between asset manager longs and leveraged fund shorts.
Synthesizing the macro, stagflation, technicals, range-bound FX, flows short Canadian dollar, long yen and risk dollar squeeze. The unified outlook is dollar strength with selective weakness in commodity currencies. The BOC and ECB are secondary to the US CPI/Fed data. The short Canadian dollar trade is the most visible institutional bet. My call, CAD bearish, target 113.5 by Friday, as the Canadian dollar is shorted by institutions and the yen is longed by leveraged funds, creating a double headwind for the Canadian dollar.
If you're finding value in this analysis, support the project at patreon.com/ShadowQuant. Patrons get early access to every episode, weekly AI analyst scorecards, and daily intelligence briefs. And if you're listening on Spotify, Apple Podcasts, or YouTube, hit that follow button and leave a rating. It helps more traders discover the show. We appreciate you. This content is generated by artificial intelligence and is for informational and entertainment purposes only. It does not constitute financial advice. Forex trading carries significant risk of loss. Always do your own research before making any trading decisions. That wraps up this edition of ShadowQuant Forex Edition. Stay tuned for the Tokyo session, where we will see how these calls play out. Until then, trade safe.